Welcome back. Look, if you're a busy investor who wants the real, unfiltered truth behind corporate earnings without having to sit through a boring 2-hour conference call packed with corporate jargon, you are in the exact right place. Today, we're tearing right into Applied Optoelectronics, or AAOI, and their Q1 2026 earnings report. By the end of this explainer, you're going to understand exactly what AAOI's unique AI data center advantage is and why it's driving absolute record-breaking revenues right now. So here's our roadmap for today. We're going to quickly cover their core financials, dive into the AI data center boom, look at their capacity and competitive moat, pull out the absolute best highlights from the analyst Q&A, and wrap up with the investment risks you need to know. All right, let's jump right into Section 1, Core Financials and Performance. AAOI delivered a massive top-line beat. First quarter revenue came in at a record $151.1 million. That is a staggering 51% year-over-year growth. And honestly, it marks their fourth consecutive quarter of record revenues, landing perfectly within management's guidance targets. Plus, we saw their balance sheet strengthen significantly, with total cash and short-term investments jumping up to nearly $450 million. And things are looking up for the next quarter, too. Their Q2 guidance is remarkably strong, projecting revenue somewhere between $180 and $198 million. But here's the kicker. Management actually aggressively upgraded their full-year 2026 revenue target from $1 billion to over $1.1 billion. Now, you might notice that non-GAAP gross margins are temporarily hovering around 29 to 30% right now due to a shift in product mix. But they fully expect those margins to bounce right back to 35% by the end of the year as their new, highly automated lines get fully tuned up. Moving on to Section 2, the AI data center boom. You guys, data center revenue absolutely carried this quarter, surging 154% year-over-year to hit $81.4 million. While their legacy 100G products still grew a really solid 36%, demand for their 400G products just exploded, growing tenfold year-over-year. On top of that, AAOI successfully completed their initial batch shipments of the highly anticipated 800G single-mode transceivers to a major hyperscale client. So the bottleneck right now? It's not customer demand. It is literally just about how fast AAOI can manufacture these parts. Which perfectly leads us into Section 3, Capacity Expansion and Moats. Because demand is so crazy, AAOI is executing an incredible production ramp-up for their 800G and upcoming 1.6T transceivers. Get this, they exited the first quarter with a capacity of 100,000 units per month. By the end of this year, they're targeting 650,000 units per month. And by the end of 2027, they plan to push that to over 930,000 units per month. And a really cool detail here is that more than half of that production will be proudly based in their newly expanded Texas facilities. Now, here is AAOI's absolute secret weapon, their self-owned indium phosphide, or InP, laser fabrication facilities. See, right now, the entire optical communication industry is facing a severe shortage of InP laser chips. But because AAOI actually owns their own fabs, they're completely bypassing the severe supply chain bottlenecks that are just crippling their competitors right now. To maintain this dominance, they're expanding that Texas laser fab capacity by a whopping 350% and upgrading to larger 6-inch wafers by 2027. It's a total game changer. Hey, right before we get into the most revealing part of the earnings call, the analyst Q&A, I want to quickly mention something. If you want to stay updated on the latest U.S. stock market news, make sure to subscribe to my channel. I upload new explainers every week. All right, let's dive into Section 4, Crucial Q&A Highlights. This is where the real alpha is. First up, we had a really vital question from Raymond James about execution risk. They basically asked, hey, historically, huge factory expansions face major delays, so how are you going to avoid that? Management's response was incredibly confident. They pointed out that they're simply taking the exact, proven manufacturing processes and highly automated equipment they already perfected in their Asian factories over the last 2 years and just duplicating it in Texas. Plus, because they internally develop most of their own manufacturing equipment, they aren't stuck waiting in line for third-party vendors. Raymond James also asked management to clarify a totally jaw-dropping metric from their prepared remarks. They had mentioned a target of $471 million in monthly data center revenue by mid-2027. Management clarified that this $471 million figure isn't some theoretical best-case scenario. It's actually a guaranteed floor. It's calculated based purely on minimum committed client orders and already planned equipment capacity. The actual ceiling for their output is much, much higher. Next, Wolf Research zeroed in on supply chain vulnerabilities. They asked if AOI might actually run out of the raw indium phosphide substrates needed for this massive laser production boom. Well, management quickly shut down that concern. They explained that they've diversified across 4 to 5 major global suppliers, mostly outside of China, and they currently hold over a full year's worth of raw substrate inventory, so they are fully insulated against any short-term material shocks. Then, Rosenblatt Securities asked about the trajectory of their revenue growth for the year. And management dropped a huge detail here. They revealed they just secured a landmark $140 million order from a returning mega client who will once again represent over 10% of their total revenue. But because of the lead time to install new equipment and get client certifications, management emphasized that growth will not be linear. They're projecting a dramatic 60 to 80% sequential quarter-over-quarter growth in Q3 and Q4 as those new factory lines officially light up. Finally, Northlands Capital asked about the threat of contract manufacturers stealing market share. Management offered a brilliant breakdown here. They admitted, yeah, for simple lower-end products, clients can and do use outsourced fabless manufacturers. However, high-end 800G and 1.6T transceivers require multiple advanced lasers, which makes them inherently much harder to manufacture. The ultimate bottleneck in the entire industry right now is laser chip availability. Those fabless competitors are completely at the mercy of backlog suppliers like Broadcom and Coherent. AOI's in-house model, with its cell phone laser fabs, guarantees supply and gives them ultimate pricing power. It's honestly a nearly unbeatable moat.
But to keep things balanced, we have to look at the other side. Let's get into Section 5, Potential Investment Risks.
The single biggest red flag for AAOI right now is extreme customer concentration. Just 3 large tech giants make up an astonishing 95% of AAOI's total revenue. One cable TV client accounts for 44%, while 2 major data center clients account for 26% and 25%, respectively. Think about that. If even one of these mega clients decides to delay an order, change their capital expenditure plans, or fails a product certification, AAOI's quarterly revenue would completely collapse. Additionally, there are some pretty severe execution hurdles to watch out for. There is a multi-month time lag, usually 2 to 4 months, between when they install new capacity and when they can actually recognize the revenue, all because of rigorous client auditing. Furthermore, tuning these brand new, highly automated factory lines creates short-term margin pressure, which is going to suppress their profitability in the immediate future. Finally, lingering tariff uncertainties remain. They took a $1.4 million hit in Q1, and while they filed for a $5.7 million refund, management admits the timeline to actually see that cash is completely unknown. All right, let's head into the wrap-up and next steps. I've got 2 quick questions for you all to spark some discussion down below. First, based on everything we covered today, what are your thoughts on AOI's massive nonlinear growth targets for the second half of 2026? Do you think they can actually pull off that 60 to 80% sequential jump? And second, which US stock or company do you want me to analyze in our next explainer? Drop your answers in the comments below. Thank you so much for joining me today, and I'll see you in the next one.